Good afternoon and welcome. This is Business Incorporated coming to you live from Lagos. I'm Chimeze Obi Iwago. On the program today, Moody's plans to cut the ratings of 5 South African state-owned firms, including utility Eskom. Zambia's finance minister calls on citizens to be prepared to endure economic pains before any gains are felt from an International Monetary Fund aid program. Plus, Botswana cuts its 2016 economic growth estimate to 3.5% from an earlier projection of 4.2%. And we'll begin in South Africa as rating agency Moody's may cut the ratings of 5 state-owned firms there, including utility Eskom, citing funding risks after some local institutional investors said they had stopped lending to some parastatals. Asset manager Future Growth, which manages client assets of about $12 billion, and rival Abax Investments, said this month that they had reduced or stopped lending to several state-run firms due to political uncertainty and governance issues. Moody's said in a statement it was putting Eskom's BA1 rating on review for downgrade on the grounds that its funding needs were increased by the rising cost of buying power from independent producers, as well as its spending to revamp and build new power stations. Moody's is also reviewing the ratings of 4 other state-controlled entities: the Development Bank of Southern Africa, the Industrial Development Corporation, the South African National Roads Agency, and Land Bank. And in Zambia, the Finance Minister Felix Mutati says the country must be prepared to endure economic pain before any gains are felt from an International Monetary Fund aid program. Zambia and the IMF started talks about an aid package in March after agreeing that the budget deficit was unsustainable due to the impact on government revenues of the depressed price of copper, its main export. In the UK, the Bank of England has left its main interest rate at 0.25%. The decision of the Monetary Policy Committee to leave rates at their new historical low level was no surprise. Only last month, the bank cut its bank rate from 0.5% to 0.25% as part of its attempts to ensure the stability of the UK's banking system in the aftermath of the June Brexit referendum vote. Now let's cross over to Frankfurt and see how investors and traders there are chewing this piece of information. Conrad Boulson, DWTV, Channels TV financial correspondent, joins me now. Good afternoon, Conrad. Well, the Bank of England has taken the decision to leave the interest rate unchanged. Was that what the market expected to see? How are investors and traders reacting to this decision?
Well, Chimmy, as this was widely expected by most economists and most market participants, there is no clear reaction on the market in terms of prices. Still, the Bank of England's Monetary Policy Committee also came out with the minutes of its last meeting, so we have been getting details about what's on the minds of the monetary policy makers in London, and these are details that many people on the markets are closely reading and fiercely discussing right now. In a nutshell, I can tell you the Bank of England is a bit less pessimistic about the UK's economy. The minutes state that, and I quote this, a number of indicators of near-term economic activity have been somewhat stronger than expected since the last rate cut in August, and the committee now expect less of a slowing in UK GDP growth in the second half of 2016. Very positive for the moment, because it means, it underlines that the consequences of the Brexit referendum in the US economy were not as strong as many had anticipated. Something else is interesting to see. The vote to leave the interest rate in the UK unchanged was unanimous. 9 of 9 members of the Monetary Policy Committee meeting were in favor of that. So that also shows that, the direction that the Bank of England's chief, Mark Carney, is giving is being supported by a majority of the influential monetary policy committee members.
Right. Now, all the central banks being eyed by investors are, of course, the Fed and the Bank of Japan, you know, as they prepare to meet next week. How's the market awaiting those policy decisions that would probably come out from BOJ and the Fed?
Well, look at what the German DAX is doing today. Doesn't this look like a bit of a volatile zigzag up and down? It indicates that there is some sort of anxiety in this market at the moment. And of course it doesn't have to do that much with what we can expect from the Bank of Japan next week. It has a lot to do with what we have to expect from the Federal Reserve. You know, if the Fed continues to rise interest rates ever so slightly next week, it would indicate, you could say, on the positive side, an end, a bit more of an end to the after-crisis monetary policy. But it would also mean that, you know, interest rates in general might be rising, will be able to rise a bit more. That's not very positive for shares, for equities. And it would also mean that the markets cannot rely that much anymore in the future on so much liquidity provided for by the central bank. So that's what's so crucial, and that's what makes investors nervous. And there's more. There are also political implications. Donald Trump, the presidential candidate in the United States, fiercely criticized the Fed recently. He says the Fed was only doing what President Obama wanted. The Fed might be inclined to do something next week only to prove its independence. Those things are on investors' minds at the moment, and those things make some of them quite nervous.
Right, we'll wait and see what the decision would eventually turn out to be. That should be on Tuesday, the 20th. Now, let's look at the troubled Italian bank, BMPS. The bank now has a new chief executive, and its chairman has resigned in a dispute over the bank's cash call. What impact is this having on the shares of the bank, and what are the shareholders and investors saying about this?
Jimmy, I have to say, you don't find many investors who want to talk about this bank because it's been such a tragedy. So much cash, investors' money, billions of euros have been burned there. This is a picture frame example of an Italian bank not able to adapt to the times after the financial crisis. Shares in the bank, and the only nice thing about it is its name, Monte dei Paschi di Siena. Before the crisis, its shares were traded at way more than 100 euros. Now the share price is down to 22 euro cents. The only positive thing people here have to say about this bank is that the hassles on the top management level of the bank, or the problems of the bank to find fresh capital, have not translated into nervousness about the whole banking sector for the moment, which means the decline of the share price of Monte dei Paschi has not had an impact on other share prices of European banks. For the moment, there is not yet, I would say, another anxiety about potential contagion.
Well, I guess the investors can now only wait to see what the new CEO will be able to do to turn around that bank. Thank you very much for your time, Conrad. We move on now to Asia, where the stocks traded mixed today amid lingering uncertainty over key central bank policy meetings next week, while markets in China, Taiwan and South Korea were closed for public holidays. Japan's Nikkei 225 slipped 209.23 points, while the Topix index fell 1.04% as stocks came under pressure from a relatively stronger yen and growing uncertainty over the Bank of Japan's monetary policy meeting due next week. In Hong Kong, the Hang Seng index added 1.03% in afternoon trade, while Indonesia's Jakarta Composite was up 2.07%. Major indices in Singapore, Malaysia and India traded lower. Australia's ASX 200 closed up 12.16 points, erasing losses of near 0.3% seen in early trade.